Good morning, ladies and gentlemen. I assume that everyone has had their fill of donuts and coffee and juice and fruit and yogurt this morning. On behalf of the Bronze Buffalo Club, we'd like to welcome all of you wonderful people to this beautiful spot, this beautiful place in the United States, nestled at the foothills of the Grand Tetons on the borders of Wyoming and Idaho. Isn't this a wonderful place and a wonderful time of year, and the weather's working for us and with us today? It's wonderful to meet all you wonderful friends. My name is Scott Keller. I'm the president and CEO of Keller Investment Properties. I'm located in Salt Lake City. The core of my business is multifamily and student housing in the western United States. People will often ask me, so hey Keller, what's up? And I say the rent. Well, that's good for me. That's not always good for somebody else, but a sign of a strong economy. I've talked to some of you in the last few days, and many of you have never been to Wyoming. I guess it was 15, 20 years ago, I had a rental car, and I was getting gas, and this is back in the days of full service gasoline, wash your windshield, check your fluids and air pressures. You remember those days? And you just know this old boy, this young kid was told to write everything down on that license plate if a credit card was used, and this rental car was a Wyoming plate. And of course, you know what that looks like. And after I watched him tear up that invoice 3 or 4 times, I'm in a hurry. And I walked back there to see if I could give him a hand, and he's looking at that Wyoming license plate, and he says, "Say, mister, I can't draw that horse." He's trying to get that cowboy hat on that cowboy and that horse. I said, "Look, you don't have to write that down. Just the numbers is good enough in the state, you know." So, on behalf of the Bronze Buffalo Club, we welcome all of you wonderful people. We look forward to an exciting, informative time as we meet new friends and we become more informed with this economic summit. We're very excited about the amazing individuals that we have here today and the opportunity to interact and learn from one another. The spirit of this event was born in the midst of the financial crisis, and over the past decade has grown because of the uniqueness of the coming together of America's industry titans. Over the past few days and through this afternoon, America's captain of industries, financial, manufacturing, real estate, media, have engaged in collaborative dialogue and have appreciated the diverse opinions, something that is a staple to America's greatness. We would like to thank our partners, the GIC, for their great work with us to host this annual event. We would like to recognize our amazing title sponsor and partner of the 11th Annual Rocky Mountain Economic Summit, our friends at OtterBox. This event is the level of success because of their wonderful generosity. We would like to also thank our other longtime partners and sponsors, Alan Olson with GrowCo, Shane Baum at Leisure Society, KSL, Entrepreneur Magazine, Mass Mutual. Please join with me in thanking them. At this time, I'd like to turn the time over to Chairman Don Rissmiller, who is the chairman of the GIC.
Thank you very much, Scott. I am Don Rissmiller. I do economic research at Strategist out of New York, and it is my honor to be GIC's chairman for this year. So we have a lot to talk about on the economic front this year. We have inverted yield curves, we have tariffs, we have a manufacturing slowdown, And we're going to get to all of that in the various panels over the course of the day, and we hope everyone can come away with something to take home. So let me tell you a bit about GIC. GIC was started in 1976 when there was a celebration of American independence. There was a group in Philadelphia of forward-thinking individuals who thought at that time that independence should be accompanied by interdependence, and that's where the Global Interdependence Center got started. There are a number of individuals in the audience here today, David Kotak, Bill Dunkelberg, who have been great founders and leaders of the organization over the years. We'll hear from them today. But it's on their shoulders that I and others stand and look to take this idea forward in what we think is an increasingly important time. So let me also say thanks to Justin and Cody and Scott, Chad, and Randy for, again, helping us bring this event into being. We have a number of distinguished guests here. And so let me just do a couple housekeeping items and we can get started. First, those speakers who have given us permission to do so will have their slides available on the GIC website, which is interdependence.org. And also the restrooms are just past the hotel down at the grill, should you need that over the course of the day. So with that, let us get started. Let me turn the microphone over to the moderator of our first panel, Jeremy Schwartz, who is the Global Head of Research at WisdomTree Asset Management, will let us begin.
Thanks, Don. It's a pleasure to be here, and it is an exciting time to have everybody here for this economic view. There's so much going on in the economy, the markets. We've got Powell testifying. We've got President Barkin here to talk about his view on what's going on at the Fed. So our panel today, we have 4 great experts across the globe, from William Strauss, who's the senior economist, economic advisor at the Federal Reserve Bank of Chicago, with a real focus on manufacturing and all the trade issues. He's going to shed a lot of light on that. We're going to talk with Michael Drury, who's the chief economist at McVean Trading and Investments. He's a former chair of the GIC and just came back from China. He's going to give us his take on what's happening in China with the U.S. We're going to have Megan Greene, who is fresh on a new program as a senior fellow at the Harvard Kennedy School. And finally, we're going to have Jeffrey Korzenik, who's the chief investment strategist and senior vice president at Fifth Third Bank, talking about the labor markets and some unique dynamics there. I'll come back for some moderated Q&A with all of them, but they're each going to give you 10 to 15 minutes of their own views of what's going on, and then we'll all have a chance to ask them some questions. So we'll start off with William Strauss.
All right. Do we have the clicker? I know there was some problem and we might not work even today. We'll see. I think they were testing it earlier. Didn't seem to be getting it done. But as Jeremy mentioned, my slides will all be available. All right. Yeah, very good. Thank you. My slides will all be available on the GIC website. I've got quite a few. I've got 15 minutes to cover the largest economy in the world. So we'll be doing it at a 30,000-foot view. And I certainly look forward to hearing from President Barkin with regard to his view on inflation and Fed policy and so forth. Anyway, let's get started. So I'll give you a next. Even this one seems not to be doing it. All right, so we have data through the first quarter of this year. We'll be getting second quarter GDP at the end of the month, but at this point, data through the first quarter has GDP rising by 3.2%. That is quite good number, but it's expected, next slide please, that when we get the second quarter data, it'll show a little bit marked slowdown with regard to activity. The Chicago Fed produces what's known as the National Activity Index, the CFNAI. And that indicator, when it is at a reading of 0, which is that solid black line going across the screen, it means that the economy is growing at near its trend rate of growth, which the FOMC perceives as being between roughly 1.8 to 2%. You can see the most recent readings have us actually below that. So there has been kind of a marked slowdown. We have data that goes through the end of May. So we have basically 2 out of the 3 months already reflected in this data. So its higher frequency kind of alerts us to what we can likely expect. what was just added on there is the recession risk area. When our indicator gets down to about a -0.7 to a -1.3, that's where it historically has been associated with actually declines in economic activity. And we kind of moved down towards that, but we're still far away from it. And in fact, the most recent reading, especially the 3-month blue line moving average, moved higher. So I think, we're looking at an economy which is not going to be quite as hot as we saw last year, but still, all in all, as we'll see, expected to be relatively well. Next slide, please. And you can see that reflected with regard to the equity markets. They're at near record highs, and this is a forward-looking indicator. And in fact, it's one of the 10 of the leading economic indicators that the conference board puts together. And so that certainly would be suggestive of people feeling good about the outlook. Next one. And in fact, we just had one of the special FOMC meetings. We have 8 of those a year at a minimum. Every other FOMC meeting is known as a SEP round, a summary of economic projections, where the 17 policymakers who comprise the FOMC, which includes the 12 Reserve Bank presidents plus the currently seated 5 governors, provide their outlook for a bunch of key economic indicators, so real GDP, a couple of measurements of inflation, unemployment rates, as well as their primary Fed policy tool, the federal funds rate. I'll be presenting all of those this morning. And what you can see is that the red diamonds there is the midpoint of those 17 policymakers. The blue shaded box at the very top gives the central tendency around where most of the policymakers seem to reside, to give you a sense of the range that we might be thinking about. But the blue shaded area right around that 2%, just below it, that's the longer run view of where the FOMC perceives to have the long run growth for the U.S. economy. So it's not 3%, it's again around 2% or just under that. And the good news is that the forecast calls for growth to continue all the way through 2021. But it's not going to be the kind of impressive growth that we saw last year that was well above trend. It'll be a number closer to around 2% all the way out. I should have also started off, and I apologize for that, we should all be celebrating. We are now in the 11th year of our economic expansion, assuming that we're still growing this month. And the previous record was 120 consecutive months, which took place during the 1990s. So we are kind of in uncharted waters at this point in terms of the duration. And I think that the duration is very likely to continue, and certainly that is what the policymakers are suggesting. In part, I think the domestic economy for the U.S. remains very solid. There are really no real side sectors of the U.S. economy that appear to be overheated, that appear to be at a point where you have to worry about a pullback because they've gotten too far ahead of themselves. Just look at the last recession led by a housing market that, in technical terms, went nuts. And when that corrected, it didn't just bring down the housing market substantially, but of course took down the financial markets that were aligned with it. Next slide, please. So I mentioned about the leading economic indicators, which the stock market is one of the components. That too has continued to be relatively strong. It's been more flat of late, which is sort of suggestive of this slowing of activity. So there's a lot of mixed signals that might be out there. But still, all in all, it has not started to go down, which is what often would be the case if this indicator was talking about a recession. It tends to move down ahead of a recession, and it's not begun to do that yet. Next slide. One of the strengths of the economy remains the employment market, where we continue to be able to add an amazing number of jobs, 2.3 million over the past 12 months. This is astounding and well above certainly what the Chicago Fed perceives as the underlying number of jobs that we should be adding or be able to add each month, which is actually closer to around 80 to, we argue sometimes, but maybe 90,000. But I think most of our staff is leaning towards 80,000. So that would be a number closer to 1 million a year, as kind of a more normal matching the growth of the labor force with the retirees and so forth. So it's pretty astounding that we're still able to add these many workers. Next slide, please. The unemployment rate at 3.7%, close to a 50-year low with regard to this reading. This would certainly be, indicative of a labor market that is all in all quite hot. But even just yesterday, Chairman Powell suggested that the labor market, because of what we're seeing on wages, is really not at that kind of heat level. Next slide. What is expected? So here's one of the other SEP charts by the FOMC. They perceive that the natural rate of unemployment, the unemployment rate that the economy would normally gravitate around, is between 4 to 4.4%. We are below that all the way through the end of 2021. Now, this would normally be a time period of concern for inflation that could be induced by a tight labor market. The fact that if you're having unemployment rates that are below the natural rate, shouldn't that lead to wage pressures, which would lead to cost pressures, which would therefore lead to inflationary pressures? And I'm going to present a little bit of a story with regard to why I think the FOMC is a bit sanguine with regard to this reading. Next slide, please. First off, employment cost measurements of looking at wages in green, benefits in red they're increasing and the pace is picking up a bit, but not very much. We're looking at a little over 3% increases, and this is in nominal terms. So knock out the inflation, and we're seeing the fact that wages have not done very well for a very long time period. And for a vast, large share of Americans who don't have equity investments and have not enjoyed that stock market equity gain, who have to basically survive based upon what their paychecks are showing, the gains that they've seen over the past 10 years has not been all that impressive in real terms. And I think that has led to a lot of frustration that we have seen in the economy. As an example, next slide, I think that where we are with regard to the wage gains is very disappointing compared to perhaps where we should be. And this is a little bit my opinion, but it's also based upon some work that we'll hear from Bill Dunkelberg and his work that he does for the National Federation of Independent Businesses. But I'm stealing one of his indexes here. The blue line is his index where he asks his members, do you plan on increasing compensation? So it's a forward-looking indicator. I lag it by 9 months and match it up with the employment cost index on wages, and you can see how nicely it's correlated. In fact, 84% correlation over this time period. His indicator would be suggestive that we should be experiencing closer to a 4% increase in wages rather than the 3%. So the point is, I think, going forward, I think there could be expectations that we would see higher increases in nominal wages, which would, all in all, in my view, be a good thing especially for those individuals that I mentioned earlier. Next slide, please. So the question is, why have wages suffered so much? I think in large part it's been the fact that ultimately workers receive, in terms of real gains, what they deliver in terms of productivity growth. And productivity growth has not been doing very well during this current expansion up until late. We normally think that if you're going to have a 1.8 to 2% growing economy, that kind of goes along with about a productivity trend growth around 1% to 1.25%. You can see that this is a 5-year moving average, that we were below 1% for an extended period of time, roughly accounts for about 9 years. So again, I think the fact that we saw this really weak productivity led to really weak gain in real wages. The good news is that we're seeing this pick up of late. Now, what drove this weakness, next slide please, I think has to do with the slack in the labor market that resulted in nearly 9 million people losing their jobs, and we saw wages weren't rising very rapidly. We saw a substitution for capital by using labor a lot more, and the fact that the growth of the economy was not that aggressive. In fact, from the beginning of the expansion to where we are at this point, just 2.3% annualized rate of growth, barely above, again, what we perceive as trend growth. So we saw the fact that investment really weakened substantially. And of course, investment is a key part of productivity improvements. The good news is that that has come back in the last few years. Next slide, please. And with that, you can see that productivity growth has, in fact, recovered and is doing, all in all, quite well at this point. Next slide. So with that in mind, if workers are delivering more productivity, you could afford to pay them more, and it will not be inflationary. In fact, we have a measurement to reflect that called unit labor costs, which takes into account the productivity improvements versus the increases of cost of having that labor. And with the most recent reading, it's actually negative. Now, we can debate upon whether there's something strange going on in the last quarter's worth of data and so forth. The main point I want to make here is that if you are really worried about a wage cost spiral on inflation, it should be going higher, certainly not going down. And we've seen this weakening of unit labor costs. So again, I think that's giving some room for the Fed to be thinking about keeping these unemployment rates a bit lower because of this inflationary or lack of wage pressure. Next slide, please. Okay, I'm going to move through these more quickly. Profits remain decent. Next slide. Inflation, the Fed has a target of 2%. Next slide. We're below that. Some of that is due to the fact that we've seen this weakening of energy prices that coincided with the weakness that we saw in the fall of last year. Next slide. Energy prices are a real bargain. So here's the energy spend by consumers. Next slide, just to add to it. You can see how very low it is from a historical standpoint. So fuel is really inexpensive in the country. Next slide. Removing food and energy, we still, though, see the fact that the core rate of inflation remains, all in all, quite low. Next slide. So what is the Fed expecting? That we're going to see below the target of 2% for this year, but the belief is, hope is, that as the expansion continues, we'll see those inflationary pressures pick it back up close to the Fed target of 2%. Next slide. For also the underlying rate of inflation kind of moves its way up as well to that 2%. Next slide. This is one that will, you peruse on your own. The main point here is that we probably have the strongest economy in the world. This is the latest blue chip forecast for growth around the world. And there's nobody setting the world on fire with regard to their economic growth. We're seeing the fact that we still remain probably the strongest economy in the world. Next slide, please. You can see the weakness in manufacturing, which has struggled this year. This is world manufacturing indexes. Yellow is flat, so basically not much growth at all. Germany went through a really rough patch in red, but you can see that beginning this year, the top line is the globe. We hit that flatness. So it's not just weakness of manufacturing in the U.S., it's weakness around the world. And perhaps some of the trade issues that we've been dealing with of late might be playing a role in some of that. Next slide, please. The housing market, still not back to normal. Our housing experts think a number around 1.4 to 1.5 million is kind of normal. Blue chip is not even thinking that's going to happen all the way through next year. We'll have to wait beyond that to kind of see that happen. Next slide. Industrial sector, yeah, we had a tough first quarter. This is the latest blue chip, which came out yesterday, 50 non-Fed forecasters, and they see growth is going to continue, and that kind of matches my contacts. We just had a manufacturing roundtable at the very beginning of July, and while it's been a tough first half of the year, they're all kind of thinking that's still going to be doing okay, and that their order levels still remain fairly decent. But the pace of growth that we saw last year is absolutely pulled back. Next slide. So let's just close off by just quickly talking about the financial markets. This is an indicator of a credit spread difference between two corporate bond purchase or issuers, high yield, so the risky stuff, junk bonds, versus corporate AAA. And if you're worried about a recession, I kind of use this as a recessionary indicator. If you're worried about a recession, you're going to be worried about the junk bonds not paying you back. So that this would tend to push this indicator up. And you can see that it jumped in the fourth quarter of last year as there was an increase in recessionary risk, but never got that high. And in fact, this year, it's kind of come back down a bit and still remains, all in all, quite reduced. Next slide. But of course, the yield curve is another thing to think about. And in fact, we did get the inversion that occurred between the 10-year and the 3-month. The question is that a harbinger of a potential recession? And then probably the most important thing, next slide, I wanted to see out of the blue chip was their latest assessment, which all in all had remained fairly optimistic that the yield curve would not really invert or remain inverted for very long. And this is as of yesterday's release that they are predicting that while they were expecting the third quarter to remain, again, relatively flat. They expect that as we go towards the end of the year and into next year, the inversion to really not be very significant and in fact turn around, and we see a positive yield curve as we go into 2019 and 2020 for next year. All right, next slide. So lastly is the Fed with regard to their outlook for the federal funds rate. So President Barkin and I were just talking about sometimes the averages or midpoints even can throw you askew. I have a hard time kind of explaining the red dots in this particular forecast, where they basically say no change this year, a drop next year, but then back up in 2021. My personal view is that if you think that the economy is in need of some kind of a adjustment, you do it now. And so I would just say, don't get all worked up in the timing of those red dots. In particular, look at the central tendency, which pretty much remains consistent all the way through 2021. So basically, the Fed, I think I take out of this that the Fed sees an economy which is a decent economy. The issues about trade is definitely an issue that's weighing on business decisions, especially on the investment side. So we'll have to see, again, what's expected with regard to policy, but I'm sure we'll have some discussion about that throughout the morning. Next slide. And I think that's basically it. So thank you, Jeremy, and I hope I didn't take up too much time beyond. But again, all these slides are available on the GIC website. Thank you.
Good morning. I saw the same crowd here last night. Boy, you guys dress up nice. I'm going to talk a bit about China and specifically about trade, and probably pretty much from the Chinese side, because most of you know what the Americans think about what's going on in the trade war right now. And I guess my bottom line is that the trade war is not going away. It's a permanent fixture in your lives because there's going to be ongoing competition between the United States and China on technology. And so what happens in the manufacturing sector may be one thing, but what happens in the technology sector will be an ongoing battle. Next slide, please. The main thing to keep in mind is that China is not an exporting economy. It was. Back in 2008, China had an 8% of GDP net exports. It was following very much the Japanese, Taiwanese, Korean methodology of mercantilism. Then there was this thing called the Great Recession. And basically, there were no exports to sell into because the entire world collapsed at the same time. And the Chinese realized that if they were going to continue to survive, that they had to rely on themselves. And so they shifted to a move west young man kind of manifest destiny, American continental model, where they pushed more and more of their industry, low-tech industry, into the West. I was just in Chengdu, China, which is kind of the far west of China. There's a lot of China beyond that, but there's nobody in it. So that's kind of the boom phase right now. And it's growing, it's booming. But then I came back to Tianjin and Beijing, and not so much. It's pretty soft on the East Coast. The bottom line there is that the main thing that happened when China went to this continental plan is that it freed up labor, skilled labor, very skilled labor in some cases, on the East Coast. And that was the beginning of the competition between the United States and China on technology. And since they're not going to stop moving west and they're not going to stop trying to move up the ladder, that's going to be an ongoing problem. You'll note now that it looks like exports have flattened off here. In point of fact, exports in the last month hit $2.5 trillion in China. That's the same number that they were in 2014. They've had 2 credit crunches in China since then. The global economy has kind of been lackluster since then, and so they haven't really picked up any export sales. In the meantime, their domestic economy has grown 28%. So, next slide, please. The real deal is that the export part of the economy is the black part of the economy. That's the private sector. That's the guys that most of you deal with when you deal with China. And those are the stories that you hear come back. Problem is, the red part is the party. And the party used to be in the export business, and they're not anymore. The businesses that they control, that they worry about, that they think about, that have clout in Beijing, are not in the export sector. So the export sector got credit crunched a year ago, and it's only under great duress that the Chinese have backed up and allowed them to grow again. So there's a real disparity between the stories that you hear in the United States and the anecdotes, which are from Americans that are dealing with export-oriented guys, and what's going on in China and what the Chinese worry about. And the party worry about the 97% of China that's not in the net export chain. Go to the next chart. We all know that people who are dealing with the international economy are doing poorly. And in China, they're doing especially poorly, especially down in Guangdong province in the south, which accounts for about a third of all Chinese exports. They may be down 50%. So a third of Chinese exports, which is about 8% of their economy, is down 50%. That's pretty bad. But it's still only enough to drag an economy that should be growing at 6.5% down to maybe the low sixes, maybe the high fives. Next chart. The reality of what's going on in China is if you look at the black line, that's total profits. The red line is the government, the blue line is the private sector. Go back and look in 2012 and 2015, their last two recessions. The red line goes deeply negative. The party takes a tremendous hit. The central government eats the recession. The blue line never goes to zero. Never. Because if the people, if the private sector, if the non-party is suffering, they might not like it. And the party does one thing every day. It wakes up and says, how do I stay in charge of the world? And the way to stay in charge of the world is to make sure that the blue line is not unhappy. They don't have to be happy. They just have to be not unhappy. You all know what's going on in Hong Kong, and they're not happy, and the party's in trouble there. Next chart, please. So one of the things that the party is trying to do is to introduce the concept of default, of debt, of bankruptcy. So bankruptcies, and you'll hear these quoted all the time, and bankruptcies have quadrupled in China over the last year. They're now 120 billion renminbi. That's $20 billion in a $14 trillion economy. It could triple, quadruple, quintuple, whatever you wanted in the next 2-3 years, and it still is just, a speck. So they're trying to introduce the idea of risk, but they're stuck with the idea that the party still can't introduce too much risk without making the people in the street unhappy. So I don't really worry when people talk about debt or bankruptcies or default in China. That's the party's problem, and they're big enough and rich enough to handle it. Next chart, please. So one of the real things about the trade war is that if you look at, this is China, Hong Kong, their export pie, it looks like the world economy. About a quarter is to Asia, about a quarter is to the United States, about a quarter is to Europe, and about a quarter is to everybody else. Next chart, please. This is the US export pie. It looks exactly like China's export pie. About a quarter to Asia, about a quarter to NAFTA, about a quarter to to Europe, and about a quarter to everybody else. The trick is the China part's a quarter, not counting China, because we're not counting them. So close to China is their biggest part, and the quarter in the United States is just Canada and Mexico. Doesn't include the United States, so it too is a proximity thing. But the real deal is, to the Chinese, the trade war is 25% of their exports. And to the US, the trade war is 25% of their imports. To the rest of the world, it's 50%, because both China and the United States are pounding on them to do something about what's going on out there. So the rest of the world is suffering more. Next chart. So where are we in the trade war? The important part of the trade war ended in May, when Trump went to 25% on $200 billion. The Chinese didn't really care about the early part of the trade war, solar and washing machines. Yes, it hit their industries, but it's very small dollars. Then you got into steel and aluminum, but that was global. That wasn't just aimed at the Chinese, that was aimed at everybody, and so the Chinese absorbed their part and went on down the road. Then you got to the 25% on $50 billion, but it wasn't on $50 billion, because when the US said we're going to do it on $50 billion, enough people complained in the United States that we backed off and we only did it on 34. And then we went out and found another 16 billion and added it a month later. Then the big kahuna came in September when Trump said he was going to do 25% on 200 billion. The Chinese panicked. They panicked because they knew that that would be almost a death blow to their economy. And so they came and they said that they would discuss, and they came to the G20 in Argentina and they negotiated. The first thing they negotiated was, well, we'll come to the table, don't do 25%. And Trump said, okay, I'll only do 10. Well, 10 was still a problem, but they could absorb it. And at that point, they started playing for time. The longer they could delay, the more they could stimulate their own domestic economy and catch up. When Trump came with the second 15%, that was what they had been worried about, but they had now steeled themselves to be able to absorb most of it. The next, I'm going to hit you with 25 on 325 billion, the Chinese don't care. Next chart, please. Of the stuff that's been tariffed so far, if you go to the bottom of the chart, most of it is intermediate inputs. Only 18% of intermediate goods are not facing 25% tariffs at this time. We tariffed intermediate goods because it's easy to hide the impact on the US consumer while still punishing the Chinese producer. Because, let's say 30% of the good comes from China and that went up 25%, so it's really only 7.5%, and somebody in the supply chain can absorb that 7.5%. They won't like it, but it can be done. If you do it now on toys, footwear, textiles, clothing, where they produce 90% of it, the Chinese are just going to tack 25% on, and it's your problem, not my problem. Well, what about the other stuff? Final goods, 72% aren't tariffed, 69% of capital goods aren't tariffed. Next chart, please. Those are not Chinese. Those are Taiwanese, Japanese, Korean, American. Those are goods like the iPhone. You've heard this story 1,000 times, where the parts go in, they're assembled, they come out. It's all Chinese export, but it's 60, 70, 80% foreign content. So the next round of the trade war is a problem for Asia and the United States, but it's not so much a problem for China. And that's why the Chinese are stiffening and becoming less flexible. They've already suffered what they see as the worst part of the trade deficit. Next chart. One of the big questions I run into is, what happens now? People are moving to Vietnam. People are moving to, out of China. They're scurrying away. So where will they go? So I went back and I took every country in the world with more than 25 million people and ranked them by their GDP, because that kind of GDP per capita, because that kind of gives you an idea of where they are on the trade scale, where they are on the jobs ladder. And you can see I broke the United States up into 5 pieces because 300 million people is not a single economy. I broke China up into 10, each about 100 billion. I broke India up into 10, each about 100 billion. And what you see is you've got the US Northeast and West at $70,000. That's the suburbs. Doctors, lawyers, no manufacturing. Then you've got the US Midwest, the US resources, the ag, the mining and minerals, and the oil patch. Then Germany and the US South in competition, basically at the same 48,000. That's where the rubber meets the road. That's why BMW is moving to South Carolina. Mercedes is moving to Alabama. But below those, there's a whole bunch of developed world competitors that are anywhere from $25,000 to $40,000. And that's been the traditional trade flow, is are you going to those places or looking elsewhere? Notice that the lowest one, Saudi Arabia, doesn't really count because they're not a manufacturer, but Taiwan, South Korea, 32 and 25,000. Go to the next chart, please. Then we drop like a stone to the east coast of China. Shanghai, Southeast China, that's Guangzhou province, and Jing-Jin-Ji, and SD, that's Beijing, Tianjin, Hebei province, and Shandong province. They're all between 10 and 15,000, so substantially below the next highest competitor in Taiwan or South Korea. And their competition, Argentina, I'm going to go there and do business. No. Maybe Poland, Russia, not so much. Turkey, yes. Brazil, yes. And then you're into Malaysia, Mexico. So those are the real competitors. Below that, everything's China. And that's the real story, is that if you're in China now and you have to pay 25% tariffs, probably the best place for you to go is further into China. You already have the system, you're already dealing with the logistics, the language, the marketing, the human resources, the government relations, et cetera. Where people are talking about, let's go to the next chart. Next chart, please. Oh, there we are. They're talking about Vietnam. Vietnam's at $2,300. There's a reason Vietnam's at $2,300. I don't know how many of you have ever been to Vietnam. I spent one night there, and that was one night too long. It is a third world country, and I mean third world country. There are 90 million people in Vietnam. Only 30 million of them count because 60 million still live out in the countryside. There's no logistics. There's no infrastructure. People are moving, but Vietnam is already basically full up. Costs are exploding there because of everybody trying to move in. Who's moving in? The Chinese first, because a lot of the Chinese live down on the southern border. They speak the languages. They know the people. All the infrastructure, all the government, that's all going to be Chinese influenced. It's no different than firms moving from Detroit to Alabama. You know, yes, it moved from Detroit to Alabama, but Ford and Michigan still owned it, still controlled it, still took the profits off of it. So when I hear these stories about people moving, it's not Vietnam that's the market, it's India. Because if they start moving to India, that's a vast market that you'll make a huge commitment to. And it's really cheap. They're at $2.7 trillion in GDP, which is about where China was back in 2006, 2007. And they're at about $2,500 per capita, which is about where they were. Okay, next chart, please. So these are just some quick charts to show you where China is and where the global economy is. The Chinese credit cycle leads the global cycle because the Chinese credit cycle is what affects manufacturing decisions around the world. And so when they credit crunched, we slowed down, and when they've expanded credit, we've picked up. They've started to expand credit. We're looking for a pickup. We would have expected it sooner than this, but it hasn't come. Next chart, please. They're throwing stimulus at their economy like few people have ever thrown stimulus at their economy. It's at least 4% of GDP. We did 5.5% to get out of the Great Recession. When they admit to 4%, it's probably well above that. So we think they're throwing as much stimulus at their economy as we would have if we were, negative 2%, which suggests to me that China was close to zero back in the fourth quarter. Next chart, please. On the global scale, you can see, the Chinese, that's the black line. It had a pop, and then they got hit with the second round of the trade war. It's still higher. It looks like it's probably bottomed, and that's what I thought I saw when I was there, is that it's bottomed. It's not getting better, but it's bottomed. But now Europe appears to be bottoming, so, maybe the manufacturing global recession is over. Next chart. These are just a bunch of charts to say, where is China right now? Well, their stock market's up, our stock market's up. Next. This is the Li Keqiang index. You use freight and rail traffic to tell you what's going on. They bounced. Now they're kind of moving sideways. Next chart. The Baltic Dry Freight Index, that's recovering. Next. Trade, imports, and exports, those look to be recovering. Taiwan's not, Korea's not, Taiwan is, so people who look like them are also at this bottom. Next. Their PPI, which is the most closely correlated number to their nominal GDP, looks like it's turning higher. Next. And the yuan had a recovery, then fell, and now looks like it's bottoming too. So there's a lot of statistics that tell us that China's no longer getting worse, but may not be getting better. At this point, I had expected them to be through 6 on their way to 10% growth because of all the stimulus, but it looks like the second round of the trade war has taken the wind out of those sails, and they're probably at 4, trying to get to 6. That's my story, and I'm sticking to it. Happy to answer questions.
Thanks. I've been asked to talk about Europe, and I don't have any slides, so there will be no death by PowerPoint. For me, you're just going to have to look at me instead. I hope that's okay. First of all, I just want to put Europe in a bit of a global perspective, just because we have been talking about everybody slowing down. And I want to point out that everybody should be slowing down. There are really only 4 ways to boost growth. 2 of them are real sugar hits, so that's a fiscal stimulus or a monetary stimulus. We're not seeing any of those yet. We might start to see some rate cuts as soon as this month. Probably no major fiscal stimulus coming out of any developed countries. The other 2 ways are to boost your productivity growth. Actually, on that front, the U.S. has been looking a lot better recently. As President Barkin said earlier on TV, it's probably too early to claim a victory on that. We're not sure it'll be sustained. But we're not seeing productivity growth really accelerate anywhere else. And the 4th way is to boost your labor supply. Well, immigration is a really good way to do that. Ironically, Japan's the only country that's actually encouraging that among developed nations. So in the absence of those 4 items, fiscal stimulus, monetary stimulus, jump in productivity growth, or jump in labor supply, nobody should continue to grow well above potential growth. So Europe is a front runner in slowing down, but it should be slowing down. We should expect that. And most developed countries, to be fair, are slowing down from well above potential growth, so there is some room before we all go careening into recession. So that's the optimistic part of my talk. Now I'm going to focus on Europe, where things actually aren't really looking that great. I'm going to start by talking about Germany, because Germany is the growth engine of Europe. Germany just barely skirted past a recession at the beginning of this year. And there are some indications that Germany could actually be going into recession later this year. Capital goods production, it's down. Intermediate goods production is down. Motor vehicle orders are down. To use a technical term, factory orders fell out of bed. In June, they fell 8.6% year on year. That's the worst that we've seen in 10 years. So economists like me, we all explained what was going on in Germany earlier this year by talking about the levels of the Rhine, which sounds like a lame excuse now, but hear me out. The levels of the Rhine were really low, and so barges couldn't get up and down the river, and shipping costs over land were 4 times what they were shipping along the Rhine. And so that was really putting a damper on business conditions. But based on all those indicators I just put forward, I don't think it's really the levels of the Rhine anymore. There was a Volkswagen scandal. That's a piece of it, probably. The car industry is pretty big for Germany. About half of some German companies' cars are going to China. Less demand, we've heard, is coming out of China, so that's really hurt Germany. But also, you've seen diesel bans in lots of cities. There are a ton of diesel cars still out on the roads in Germany, and so a lot of Germans stopped spending because they were thinking they had to buy new cars. Most cities have reversed that, so maybe there will be a bit of a stimulus from consumers off the back of that. Probably not a major game changer. So Germany's not looking great. In the Eurozone crisis, Germany very smartly decided to pivot so that it had huge exposure to China. That hasn't played out very well in the past year. Germany's kind of facing the China shock that the US faced a couple decades ago. So Germany, the growth engine of Europe, not looking that great. I've always thought that the European project would live or die in Rome. Italy is the 3rd largest economy in the Eurozone. It's got a massive debt burden. Italy doesn't grow when times are good. So given what I've just said about Germany, that doesn't bode well for Italy. And actually Italy, whereas Germany just skirted past recession earlier this year, Italy went into recession. Last fall, we had an election in Italy where we saw 2 populist parties form a coalition. And they both promised to spend a ton, essentially. So Italy put its budget out, presented it to Brussels, because there are all kinds of spending rules in Europe. And Brussels turned around and said, no way, you don't have the room to spend that much. There was a major fight. Borrowing costs rose in Italy. That actually pushed Italy into recession. That was a major reason why Italy went into recession. But Italy backed down in the end. Everyone breathed a sigh of relief. The problem was that Italy went into recession, so when it submitted its deficit to GDP figures to Brussels, the fundamental assumption was that Italy would be growing, and then Italy actually contracted. So the GDP figure went down. That elevated the deficit to GDP figure. So it turns out, many of us could have told you this would happen, but it turns out Italy missed all of its targets for its deficit by a mile. So Brussels turned around and said, you know what, this is against our rules, we're going to do something about this. And what the EU can essentially do about it is to fine a country. So it's taking a country that's cash-strapped and saying, we're going to fine you because you're in bad fiscal shape. It's a little bit counterintuitive. It's never been done. Borrowing costs rose a little bit, and then Europe had all these new top jobs open. And there was a bunch of horse trading, and the Europeans got really distracted by choosing a new head of the ECB and a new head of the European Commission. And so they kind of forgot about Italy, and the Italian government said, yeah, okay, we'll have a smaller deficit, we just don't really know how, and we're not gonna tell you how, and we'll make no promises. But we will say we'll have a smaller deficit, and the Europeans sort of said, yeah, okay, we don't have the bandwidth for this. And so everyone's forgotten about Italy. And I'm giving you this whole backstory because every fall, Italy has to produce a budget, and sure enough, come this fall, Italy's gonna produce a budget that's gonna upset the bureaucrats in Brussels again. We're gonna have this big spat all over again. Italian borrowing costs will probably go up. There's no real way for these two parties in coalition to turn back on all their election promises, and they were very stimulative in terms of the deficit, and so we're going to have this spat all over again, and that's a big deal given that Italy is the third largest economy in Europe. It's kind of too big to bail out, and there is no fundamental plan at the European level for what to do if Italy gets into trouble. So when you talk to European officials, especially at the ECB, they'll say, oh, don't worry about it. We have this thing called the OMT program. Those of you who follow Europe probably forget what that even is. It was devised before QE. It's never been used. But basically, it's a bailout program financed partly by the EU and partly by a fund they set up for countries in trouble. And in order to access it, you have to sign up to all these rules. There are really strict conditions on it. So I've gone from Frankfurt, where I've been told, don't worry about Italy, we have this OMT program with strict conditions, to Rome and asked Italian MPs, is there any condition, any state of the world in which you can imagine an Italian government signing up to the conditions you would need to for the OMT program? And I've literally had Italian MPs say we would rather leave the euro. So there's no real plan for what to do if Italy does get into trouble, and it looks like we're gonna see Italy come back into the headlines this fall. I should also mention that the Italian government recently backed down, but they have been talking about creating these mini-bots. And mini-bots are essentially IOUs. And they're not counted against the budget deficit. It's magic math. It doesn't really work. California did this, to be fair, in 2009, so it has happened before in some contexts, but ECB President Draghi came out and said if you're issuing debt, it's either debt, or if it's not counting towards your deficit and debt, then you're just issuing money. And that's really important because mini-bots are kind of a backdoor way to start issuing your own currency. And if you issue your own currency in the Eurozone, you're out. So that is a mechanism for Italy to eventually leave the Eurozone. I'm not saying that's what they're gonna do. I don't think it is. They've backed off of this mini-bots idea. But don't forget that these two parties in coalition are deeply anti-European. They're very populist. And so I don't think this is the last we will have heard of mini-bots. So I think Rome will very much determine the success or the failure of the European project, and that should heat up in the fall when they have to submit a new budget. I'm going to mention Greece. There were years when I've come here and talked a lot about Greece. Nobody cares about Greece anymore. But people have been pretty optimistic about Greece because they just had a new election. And the center-right party won an absolute majority. So the crazies who have been running Greece, according to many investors, Syriza, the party, were voted out. They're now in opposition. And the head of the New Democracy Party that won is Kyriakos Mitsotakis. The Mitsotakis are like the Bushes kind of in Greece. Lots of them have run Greece before, so it's kind of a dynasty. He's got it in his blood to run the country. Lots of investors feel comforted by that. I'm not sure if they should feel comforted by that, but they do. Also, Kyriakos speaks fluent English. I actually think he spent some time at Harvard, where I now work. He's eminently presentable. And so a lot of investors are saying to me, this is great. Now Kyriakos is in charge. Money's just going to come flowing in. We're going to get lots of investments. There's going to be an equity rally in Greece. This is a huge opportunity, and I just want to warn you that that's not quite right. If you just look at Greece's data, Greece went through an unbelievable depression through the Eurozone crisis. I mean, from peak to trough, I guess, wages and pensions were cut by 30%. That's astounding, right? So Greece has been through kind of an emerging market style crisis, and now the optimistic estimates for Greece are about 2.5% growth for this year. That's absolutely pathetic given the depression that they went through. If you look at Argentina, Brazil, after they've gone through these huge depressions, they bounce back. Also, if you look at the current account data, Greece is actually back in current account deficit now, but it just barely reached into current account surplus. Usually when you go through that kind of a devaluation. For Greece, it was an internal devaluation. You get a huge jump into a current account surplus. Greece has kind of missed that. So it just suggests there are a whole bunch of rigidities that are still in the Greek economy. So I wouldn't be quite as optimistic about Greece as lots of investors are. I want to talk about the ECB a little bit. The minutes for the June ECB minute just came out this morning. And actually, the ECB is talking about stimulus measures. The question is kind of what can they do in the next downturn, given what I've said about Germany slowing down, Italy being a potential hotspot this fall. And so far, it looks like they're really talking about cutting rates. Now, the deposit rate in the Eurozone is already negative, so it's negative 40 basis points. That's really hurt bank balance sheets. Cutting rates even further into negative territory, I don't think that would be particularly stimulative, actually. I think hiking rates might be a little bit stimulative for banks, at least. So that's problematic. They could start tiering their deposits, which the Bank of Japan did. So certain banks will be subject to different negative interest rates based on their balance sheets and their capital ratios. That's definitely helped in Japan. So it could help a little bit in the Eurozone. Is that a game changer? Definitely not. The ECB just shut down its quantitative easing program. So could they fire it back up? They could, but they've got this capital key, and it's based on the size of the economy that's contributing to it. So Germany contributes the most, and as a result, the ECB can mainly buy German bonds. France is second, Italy third. And because the ECB's already been buying up sovereign bonds, it's kind of running out of bonds. It's got limits on what it can hold. It's kind of running out of bonds to buy. So could the ECB buy corporate bonds? Yes. Is that a game changer? I don't think so. The optimistic point is that the ECB has created the biggest monetary policy bazooka out there, and nobody knows it, including the ECB. So the ECB has these things called TLTROs, targeted long-term refinancing operations. And basically what they've done is it's a subsidy for the banks. So they've said, look, banks, you can borrow from us, and if you lend onto the real economy, we'll pay you. And so they've just offered a new round of them. They're trying to kind of wean banks off of this life support. But what they did when they created this was they created a dual interest rate. They created a second interest rate. So they've said, you know, if you lend onto the real economy, we'll pay you at this rate. Right now it's at the deposit rate, but it doesn't have to be. So what they can do is say, look, we'll pay you a ton, 200 basis points if you lend onto the real economy. And that's the borrowing rate. And then we've got a deposit rate that right now is negative, but they could increase it. And that's an unambiguous stimulus for the real economy, and I'll just explain why. Most central banks only have one interest rate, and they have to choose between benefiting savers and borrowers. So if the Fed hikes rates, then that benefits savers, but it's worse for borrowers. And if it cuts rates, it's the opposite. If you've got two interest rates, you can actually do what's good for both borrowers and savers. It's incredibly powerful. It's not without problems. It creates a massive misallocation of capital. So should the ECB do this right now? No, but in the face of a big downturn or a crisis, I think this is a really powerful tool, and I think other central banks should actually look at it. So I do think that the Eurozone's not looking great, but actually they've got the biggest tool. They've got the architecture already in place when the next downturn does finally come. And I'll just make a few comments on Brexit. I think I spoke exclusively on Brexit here a couple of years ago. Brexit continues to be a veritable choose-your-own-adventure. It's really hard to say what's going to happen with Brexit. Theresa May, the Prime Minister, has said she'll step down. Now there's a race for her replacement. Boris Johnson is by far favored to win. Boris Johnson is a populist. He used to be a journalist in Brussels. He's cheesed off most European policymakers. So for those who think Boris Johnson will be much better and will be able to negotiate with Europeans much better, that's wrong. I think, if anything, he's the man to unite Europe against him, actually. The UK is due to leave the EU on October 31st, Halloween, which seems pretty funny to me. It could be a horror. It's also the day that Mark Carney and Mario Draghi are done. It's their last day, so what could possibly go wrong with two of the major central banks involved? Having their president step down and new people come in. Boris Johnson has said that he absolutely is intent on the UK leaving the EU on October 31st, whether they have a deal or not. He's also been pretty open about not wanting the UK to leave with no deal at all, but he's intent on keeping it on the table as a negotiating tactic. I think the real risk here is that actually no deal becomes much more likely if you do keep it on the table. Yesterday, Parliament voted to bar a no-deal Brexit. They voted in favor of that by 1 vote, so it wasn't particularly a slam dunk. Boris Johnson is talking about suspending Parliament so that he can get around that no-deal issue. So it's not my base case scenario. It is certainly the most apocalyptic one for the UK. The UK would go into recession, I think. There's talk of medicine and food shortages. The UK is not at all prepared for a no-deal Brexit, but unfortunately, I think as a tail risk, the probability has risen. The probability of a softer Brexit, where the UK has a closer relationship with the EU, is also up a little bit. I think there are 2 possibilities coming up. We could get a new election, because even though Theresa May's gone and Boris will probably be in, Parliament is the same, and Parliament is incredibly divided on what Brexit should look like and whether it should even happen. So it's going to be really hard to get anything through Parliament anyhow. So the idea is we'll just get a new Parliament, we'll have a new election. There are a couple of problems with that. The Tories, who are in charge of the government right now, the Conservatives, they're absolutely bleeding support. And so is the major opposition, the Labour. So are they really going to call an election when they're bleeding support? And they're bleeding support to a new party called the Brexit Party, which is pretty ominous. It's run by Nigel Farage, who was the leader of UKIP previously. They did really well in the European Parliament elections, the Brexit Party. They'd only existed for 4 months before the elections, the European Parliament elections. In May, they came in first for the UK. So that's pretty ominous. So it's unclear that we'll have an election, but it's certainly a possibility. So you could maybe get a parliament in that could agree on anything. The other option is a new referendum, which people have been talking about for a long time. The main opposition party, the Labour Party, hasn't come through and said they definitely want it yet, but they've certainly indicated that they're interested in it. If there is a second referendum where Brits are asked if they want to stay in the EU or not, hopefully they'll be given more details on what leaving the EU looks like, whereas they weren't in the first referendum. It's not really clear what the result would be. So opinion polls are pretty inconclusive. Most of them look pretty close between Brexit and stay in the EU. So we could just have a rerun of what we've already been through. So like I said, Brexit remains a complete choose-your-own-adventure. And it mainly hurts the UK. It probably won't seriously dent the US economy. It probably won't seriously dent the Chinese economy. It could have an impact on the rest of the EU, but it will be negative for the UK and the UK's economy, no matter what the choreography is. The question is, a softer Brexit, probably better for the economy. A no-deal Brexit would be pretty bad. I'll leave my comments there and welcome the next speaker.
And now for something completely different. Not quite, because Megan did allude to the long-term structural drivers of growth in any economy, being labor force growth. How many people can you get into your labor force, and how productive can they be? And we'll wait for the slides to come up, but we'll start with the CBO's estimates. Oh, thank you very much. Okay, great. Great, thank you. And is this the, okay. I'm not seeing anything on my screen as it's shown. Yep. I can also just talk through this if we like, and then if we can get the slides going, get them going, and go in a couple slides. Let me start out by saying, if you look at the U.S. structural prospects for growth, they are going to be determined, like any economy, by your labor force growth and your productivity growth. Productivity growth over time, there we go. Can you skip through to the next page, please? Thank you. So the blue line, the blue bar is the blue bar is productivity growth, the green bar is labor force growth. And while we don't tend to talk about these things in the middle of a cycle, when you get to the end of the cycle, these become very, very real constraints. And if you look at the green bar there, the far right stack is the projection of the CBO for long-term US growth prospects, sub 2%. And the biggest determinant of why we are growing slower, or can expect to grow slower in the decade ahead, is because, thank you, is because our labor force growth is so constrained. And while it is theoretically possible for us to continue to grow indefinitely at this structural constraint, the likelihood, based on history, is not very good. When you're growing at less than 2%, it's that much easier for something to go wrong and you slip into a recession versus when we were growing at 4%. If you're going below 2%, there tend to be, and this is something we've seen over the last decade, a lot of political forces that call for change that can be disruptive as well. We could move to the next slide, please. And you can see the history of this. This is the U.S. unemployment rate going back to 1948. The vertical gray bars, of course, are periods of recession. And you can see when you get down to low levels of unemployment, when you get to full employment and can't seem to break through to lower levels, which is where we are today, a recession seems to come sooner or later. If you flip the slide, you'll see, though, that this is only part of the equation. The rest, of course, is the labor force participation rate. So it's not just what is your unemployment rate, it's how many people are on the sidelines. And of course, again, this goes back to 1948, but you can see that steep slide down towards the right-hand side of that chart. Since 2000, we have been having a lower level of labor force participation. Of course, some of this is explained, about half of this is explained, by the baby boomers exiting the labor force. So we're simply losing them. That's not going to change in a meaningful way. But we argue at Fifth Third that there are three social ills that are present this cycle in ways that are wholly unlike what we've seen in past modern economic cycles, and that these explain much of the drop in labor force participation and also critically offer a path to how we can improve our labor force participation and improve the prospects for economic growth. If you flip the slide, please. The first one, and our argument is, it's not that these social ills didn't exist in previous cycles, but they are of such a greater magnitude that they are differences of kind, not degree. The first is long-term unemployment. I'll just focus on the slide on the left. That's the average duration of unemployment. It goes up in the wake of recessions. If you lose your job in a recession, it takes you longer to get back in the labor force, get back into the employment. How much longer, though, is critical. You can see those peaks in past cycles have been 15 or 20 weeks. Look at what happened in the wake of 08 and 09. We got average duration of unemployment over 40 weeks. And we know from all sorts of other very good, solid studies that the longer you're out of the labor force, the more likely you are to drop out for good. Next slide. Probably the biggest factor, and one that went unrecognized for many years, was the impact of the opioid epidemic on labor force participation rate. And this is an incredible tragedy. This data is taken from survey data that the late Alan Kruger did. And he basically surveyed people and said, of those who are not in the labor force, how many of you have taken a pain pill? And the numbers for young men or prime age men are in excess of 40%. Now that, of course, is those who returned the survey and those who answered the survey honestly. Let me give you some other numbers. HHS, Health and Human Services, estimates that 11.5 million Americans are taking opioids for non-medicinal purposes. You know, this is, our employment levels are around 157 million. Certainly some of those 11 million are in the labor force, but I would argue that if you are an abuser of opioids, you're not able to perform to your full productivity potential, and very importantly, you're precluded from employment in many critical, high-paying jobs that require drug testing for workplace safety. Think healthcare, manufacturing, transportation, construction. All these things are real weights on the economy. And we'll flip next page. What we think is actually the most interesting opportunity to increase our labor force, and that is looking to the ranks of those who have become underemployed because of our criminal justice system. The first fact to take away is the rate at which the U.S. incarcerates people is wholly unlike the rest of the world. These are our rates of incarceration per capita. You can see next up is Rwanda. That's the company we're keeping. Now, I've been the victim of property crime. I've been the victim of violent crime. I'm not saying there shouldn't be consequences. The question is how long those consequences should last. 95% of all people who are in prison today will someday get out. It's in all our interests, from public safety and from the standpoint of economic growth, to ensure that those people become gainfully employed and reintegrated in society. If you flip the page, You also see that the impact of criminal justice changes that started in the 80s and really accelerated in the 90s had a disparate impact on different populations. The line, the top row here is 1980 rates of incarceration. Left-hand side is total U.S. The darker the state, the higher the level of per capita incarceration. The right-hand column, the right-hand side, is in the African American community. Look at what happened in the bottom row. That's 2010. Yes, incarceration had risen nationally per capita, but it was devastating to the structure of the African American community, and we've seen those results in many of our cities. Flip to the next slide. We flipped this, and we said, instead of just looking at this as a burden on economic growth and the burden on the workforce, we asked, can't this be an opportunity? And I think when you come to the numbers of the people who have been impacted by this, they are so large that there's a compelling case that if we are able to not fix all of this, but improve our reintegration rates, we can do a lot of economic good. The starting point is so low. There have been, the Bureau of Justice Statistics has done very good long-term studies. Within 5 years of people getting out of state prisons, which is the majority of the prison population, 76.6% have been rearrested. We are wasting this human capital. And what are the numbers? The number I like to use is to talk about the number of Americans who have felony convictions. It's 19 million. You subtract the number who are currently incarcerated from that, you come up to the conclusion there are about 16 million Americans who have a felony conviction. Not all of those are working age. 12 to 13 million would be working age. Not all of them are unemployed or out of the workforce, but a huge number are, and I would venture to say almost all of them are underemployed. So this is an opportunity. And in the workforce, Bill Strauss alluded to the fact that we have organic workforce growth already of about 1 million workers, but we've needed about 2.5 million. This is one of the possible resources we could look to grow our workforce at a faster pace. If you flip the slide, times are changing. The tight labor force has changed the dialogue in Washington, and critically, it's changed the dialogue in the business community. The First Step Act was the most significant criminal justice reform act. It passed in December of last year. It was signed into law. It's just getting started. It only governs a small part of the prison population, the federal prison population, but it's a move in the right direction, and it is completely focused on getting people back in the workforce. And we're seeing organizations like SHRM, the Society for Human Resource Management, the U.S. Chamber of Commerce are all getting involved in pushing this agenda. How do you get people back in? If you flip the slide, please. There is a right way and there is a wrong way. And one of the problems is if an employer does not go into this with a strategy, it is unlikely to be very successful. Employers have told me that if they've hired people with records in the past, they've either been their best employee or their worst employee. And that one-to-one doesn't work, right? One bad employee undoes the good of 10 good employees. But there's a model of success. We have studied this model. We have derived it from studying businesses that for various reasons have spent years focusing on this population and integrating them in their workforce. It's essentially a partnership with nonprofits that prepare workers and critically can tell employers who's ready for employment. And it's some modest accommodations on the standpoint of employers to understand that it's not just hiring from this population, it's keeping them employed. And that can mean things like flexible time to meet a parole officer. It can mean help with transportation, help with food security. They're fairly minor accommodations, and they do work. If you flip the slide, please, flip to a second one as well. There's basically one consistent theme we've seen from the employers who adopt this model. When you hire someone with a record, if you find the person who is ready to turn their life around, if you give them the support they need to stay employed, you get not just an employee, you actually get a superior employee. This is not about lowering hiring standards, it's hiring from a different population. It pays off in highly dedicated, engaged employees. And if you have someone who is engaged, who is loyal, that translates into productivity. We've seen very consistent evidence of this. If you flip the page, There's some other supplementary models, transitional employment, work release programs, advanced professional training. If any of you are interested, come up to me afterwards, and even entrepreneurship. It all works when done well. Flip the slide, please. What's the benefit to us? Rising labor force participation rates, better labor force growth, which means better economic growth. We have a lot at stake as we approach the end of this cycle. We can not just strengthen our economic growth, but we can extend this cycle as well. If you flip the slide, I want to do a progress check, because we've been studying this for about 5 years and talking about it actively for the last 2 years. We are seeing successes in employer accommodations to attract different populations into the workforce. The pickup we saw in labor force participation in the last employment report was almost wholly due to improvements in prime-age female labor force participation rates. We see employers constantly making accommodations, and this is great. That's the top chart here. And if you look back to the peak of female labor force, prime-age female labor force participation rates in 2000, we've got room to grow. And that could probably add alone close to a year of labor force supply. But the problem we're going to run into here is that we are approaching peaks, and that millennial women are coming into child-rearing, bearing ages, which will probably be a weight on this. Perhaps more will stay in the labor force than ever before because of employer accommodations, but we'll still see some pressure on this number. The social ills I've talked about are most greatly impact the young male labor force participation rate. That's 25 to 34-year-old men. That's the bottom line. We are not making progress. But I would stress that this effort is in its infancy, and if we can get a couple more years of economic growth, we think that we can make some very, very real progress here, and it's in all of our interest to do so. If we do nothing and don't address this and bring these people into the labor force or find ways to do it, what do we give up? Well, there's probably 2 or 3 million people missing from the labor force if you adjust labor force participation rates by sex and by age. You come to the conclusion we're missing a couple million people. That's a couple years of economic growth. And if we're round numbers, a $20 trillion economy growing at 2.5% a year, each year we give up, leave on the sidelines because we don't address these issues, that's $500 billion each year. Not someone else's $500 billion, all of ours. With that, we'll flip the slide. We can either read all our disclosures and keep our lawyers happy, or I think we can move on to the panel discussion. Thank you.
And we don't have a lot of time. I was given 5 extra minutes to do some panel discussion, so we might be able to get 1 or 2 questions. Maybe I'll get 1 or 2 questions, and then we'll get 1 or 2 questions from the audience. Megan, given that the next speaker is also President Barkin, and we're talking a lot about interest rates and central bank policy, the ECB is, what you talked about at the ECB is really fascinating on this dual rates and also, the negative rate policy itself. How do you think Lagarde could change things? How do you think about, you talked about fiscal needing, given that they all have negative rates, they could borrow more and pay down more debt. Why aren't they doing more fiscal? And just how do you think that's going to change with Lagarde?
Thanks. So how will Lagarde change the ECB? So Lagarde, like Jay Powell, is a lawyer. She's not a PhD economist, which is, I'm also not a PhD economist, so maybe I'm biased, but I think that's great. That being said, she doesn't have a whole lot of markets experience, and you might say, well, she was the head of the IMF and worked at the French finance ministry, so surely she has markets experience. She has that kind of markets experience, but she's never been an actual market participant, so that worries me a little bit. That being said, she is a mastermind politician, and insofar as the ECB has this board with a few board members and also representative from every central bank among the Eurozone countries, you always have to kind of build consensus for things. And Mario Draghi was pretty good at that, but I think Christine Lagarde will be even better. So when the next downturn comes, I do think that she's a good person to try to build some consensus for something unpopular. And something unpopular could be QE, it could be what I mentioned, using these TLTROs in a new way. But Mario Draghi has mentioned a number of times, it's not our job as a central bank only. We need some help from the fiscal authorities. I think Christine will probably carry that mantle forward, and they're both right, but I will say that about 6 years ago, I was supposed to go work for the German finance ministry, and I'm still in touch with them a whole lot. And I can say Germany is the easiest country to forecast because its red lines just never change. They're incredibly proud of their balanced budget, the Schwartz Null, as they call it. They have tons of room to actually provide stimulus now because they're in surplus. They can invest domestically. It would benefit Germany, which is, maybe going into recession. It would benefit the rest of the region. They just have this German orthodoxy whereby that's not acceptable. I mean, Schuld means both debt and guilt in German. I think that's quite telling. So I actually don't think we're going to see the picture change a whole lot on the fiscal side, whatever Christine Lagarde's efforts.
So Michael, China is also the major issue now, and so the trade dynamics, as you see, how do you see the next set playing out? Is it we're making it worse to make it better before the election cycle? How do you see the timing playing out?
Yeah, so I mean, the timing from the Chinese side is that, they don't have an election, so they're not worried about it. And they're not so sure that Trump is going to be reelected, so they're not in a hurry to finish a negotiation with him. I was just reading the news this morning, they've put 2 new guys on their board, on their negotiation board. One is their WTO expert, which suggests that they're going to try to go the Americans are evil and wicked and they're going to do this to you route, which, given what we've been doing to India and Turkey and talking about Europe again, maybe that'll work. But I don't see any movement on the Chinese side at all, which tells me that we're in for a long slog on this process. And given that I don't think we have another bullet to fire at them, or that the bullet we're firing we think is powerful and they don't, doesn't give me great hope that you're going to get a solution soon.
And Bill, from the manufacturing side, any view on the trade negotiations and how your people see it?
Well, I think the trade it's largely the uncertainty. You hear from business contacts, I think we're seeing it with regard to investment. It makes it very difficult to think about investments, where to locate your supply chains. Do you move your supply chains? If you think this is temporary or is it permanent? If you think it's temporary, you just kind of leave things and just ride it out and try to eat the cost or pass as much as you can over. But if it's a longer duration, you start to move things. We are already, though, hearing businesses that believe, and as Michael said, that this is probably going to be around a lot longer than any of us think, and whatever they can move, they're already starting to reallocate out of China. Doesn't mean it's coming back to the U.S., but they'll look for the next least expensive way of bringing in some of those goods. The main thing is with regard to manufacturing, they remain relatively upbeat with regard to activity, even with the soft patch that we've gone through in the first half of this year. And productivity is the savior of all of this, because as productivity continues, and especially in manufacturing, that means that the labor side, labor cost of whatever you're producing, is going down over time, which benefits those who have relatively higher real wages.
Well, I'm getting the wrap it up signal from the back, so I'm sorry, Jeff, I'm not going to get another question. But our panelists will all be here throughout the day. Please come up to them, continue to ask questions if we didn't get a chance to answer any questions, and we're looking forward to the rest of the day. Thank you all.